Banks create money through the process of lending. When a bank lends money to a customer, it creates a new deposit in the customer's account. This deposit is then considered part of the money supply. The bank does not have to have all of this money in reserve, only a fraction of it. The amount of money that a bank can lend without having to hold reserves is called the bank's lending capacity. The amount of money that banks can create through lending is limited by the reserve requirement, which is the minimum amount of reserves that banks are required to hold. The reserve requirement is set by the central bank, such as the Federal Reserve in the United States. The money multiplier is a measure of how much money banks can create through lending. It is calculated by dividing the money supply by the reserve requirement. For example, if the reserve requirement is 10%, then the money multiplier is 10. This means that for every $100 in reserves, banks can create $1,000 in new money. The money multiplier can change over time, depending on the reserve requirement and the amount of excess reserves that banks hold. If the reserve requirement is lowered, then the money multiplier will increase. This is because banks will be able to lend more money without having to hold as many reserves. Conversely, if the reserve requirement is raised, then the money multiplier will decrease. The process of banks creating money through lending is a complex one, but it is an important part of the way that the money supply is created. By lending money, banks are able to provide businesses and individuals with the capital that they need to invest and grow the economy. Here's a simpler explanation of how banks create money. Imagine that you have $100 in your bank account. The bank does not have to keep all of this money in reserve. It only has to keep a fraction of it, called the reserve requirement. Let's say the reserve requirement is 10%. This means that the bank only has to keep $10 in reserve and can lend out the remaining $90. The person who borrows the $90 from the bank then deposits it into their own bank account. The bank that receives the deposit does not have to keep all of this money in reserve either. It only has to keep $9 in reserve and can lend out the remaining $81. This process can continue over and over again, with each bank lending out a fraction of the money that it receives. As a result, the amount of money in the economy can increase even though the amount of physical currency does not change. The amount of money that can be created through lending is limited by the reserve requirement. The lower the reserve requirement, the more money banks can create. This is why central banks sometimes lower the reserve requirement in order to stimulate the economy.